Okay, good evening, ladies and gentlemen. So, welcome to the webinar on GST. So, GST as a whole, as the government has introduced, is a one-way system in which all other taxes would be subsumed. But since it's the inception and inception creates a lot of problems, so what we have seen is that there are certain issues that our customers are facing based on the filing of the returns for GST. So, be it the e-way bill or be it the TRAN 1 issues in terms of the billing of GST. So that is why this webinar is specifically conducted by our expert CA Ankit Kanodia, who will help you with the issues and how do you deal with them. So now I'll hand it over to Mr. Ankit Kanodia, who will take the session forward.
Very good evening to all the audience present at the webinar. So today I have been told to specifically deal with issues which are being faced while filing this TRAN 1 form. And e-way bill, of course, there has been Rule 138 has been notified, but from a date with effect from it is still not notified. But we'll just go through the basics of what the government intends about this whole e-way bill mechanism and who is to generate this e-way bill and what are the basic conditions. We'll have a quick look across that also. So starting from the first going to the transition form. At the transition form, so transition form basically in our earlier sessions we have dealt key when and what are the provisions in relation to the TRAN 1 form. Today we will see how and at what points, what are the details particularly required in order to fill in the TRAN 1 form successfully. So basically we will be having the form with us. The online form is there. We have prepared the presentation by making screenshot of each of the boxes, each of the details which is required to be filled up in this form, and thereby we will see how and what information is need to be portrayed. So when you log in into your dashboard and you see you have to select the returns tab, and under the returns tab there will be transition forms. So once you click on the transition form, you can see there dashboard returns transition form. There are three forms available: TRAN 1, TRAN 2 and TRAN 3. As of today only TRAN 1 and TRAN 3 is applicable. TRAN 2 has not yet started. So our discussion will be primarily limited to the functioning of form TRAN 1. So what is TRAN 1? TRAN 1 is again a form which has been notified by the CBC and the central government, wherein persons who are transiting from the old excise service tax and VAT regime to the GST regime, they would have certain credits with them, they would have certain forms which are pending at their end, C form, F form, H form, they would have certain raw materials which are dispatched by their vendor in the month of June but they have received in July. So they are not able to account for the same in their excise or VAT returns. Similarly, there will be some service bills which the service provider, maybe he has given the service and raised an invoice in the month of June, but due to the processing and taking the time, the bill is received by the company in the month of August, in the July, when the GST has already set in. So to cover all these situations, we have this TRAN 1 form available, wherein there are separate sections under which you need to take the credit. So on the law side, starting from section 140 subsection 1 to section 142 subsection 12, there are various provisions under which we need to fill in certain details, and we will see each of them. So once we come to TRAN 1, the first thing that is there is whether all the returns required under existing law for the period of 6 months immediately preceding the appointed date has been furnished. So there is a drop down option, yes or no. If you select yes, then only the form is you will be able to submit the form. So means you have to be first sure that all your returns of excise, service tax, VAT, CST, entry tax and all other taxes which are subsumed under GST and you were an SSC under the old law, you need to ensure that for the period of 6 months prior to 1st July, all the pending returns have been furnished. If all the pending returns have been furnished, then only this TRAN 1 would be able to be submitted and filed by the respective SSE. Fine. So once this is there, you see there are different boxes available. 5A, 5B, 5C. This 5A is all numericals from 5 to up to 12, denotes the numericals which were present in the hard copy of the form which was notified with the CGST rules. If the transitional rules, they had notified the TRAN 1 form. So all these serial numbers correspond to those form number, to the serial number of the form. It does not correspond to the respective section. What is the respective section? Once we go into each boxes separately, we will discuss. So first which we will be discussing is 5A, 5B, 5C. 5A, 5B, 5C is nothing but details in regards to the ITC, the CENVAT credit of excise, service tax and VAT, which one is carrying forward in the return which has been filed for the period ending June 2017, and there is an excess ITC available at the end of the SSC. So in such case, SSC would be allowed to carry forward this under section 140 subsection 2, 140 subsection 1 in fact, and therefore 5A, 5B, 5C, the details which is required for central tax, registration number of excise and service tax, the tax period for which the return was last filed. So for service tax, the return was filed for April to June, but here the option would be month-wise. So you need to select the period as June. For excise, the return was monthly. For some SSC, it was quarterly. So you need to select the period as June. The date of filing of the return, the exact date, you can have the date from your return copy wherein the filing date is available, and then the balance of the CENVAT credit carry forward in the last return. So you need to see what was the amount of the closing credit in your return. The amount of closing credit, suppose it was 100 rupees. So this CENVAT, which is admissible as per ITC of central tax, can be either 100 or less than 100. Why it can be less than 100? Because there may be some credits which you have taken under the service tax or the excise regime, but the same is not eligible under the GST regime under section 17 of the CGST Act with respective rules. ITC rules are there. So one needs to first analyze the same, and in such situation, if there is any difference, then the less credit to be availed under the transitional provision. The issue which comes up here is, what do you mean by CENVAT credit? So people have been questioning that whether the credit of KKC and EC and SHGC would be allowed to be carried forward under the GST regime. See, this section we are talking about is 140 section 140 subsection 1. So 140 subsection 1 credit, it's used the word CENVAT credit, and CENVAT credit under the old law, when you refer to the CENVAT credit rules, it includes credit of excise, service tax and KKC also, because KKC was allowed to be set off with the output liability of KKC. So in my humble view, CENVAT credit would include the credit of KKC if one is carried forward the same, but as regard EC and HSGC, the same is again very litigative. So under the old regime, when the 2015, when EC and SSGC was done away with, the government had issued certain clarification and circulars for people to utilize the same against their excise credit, excise output liability. But there are still many situations which the government has not envisaged at that moment of time, and therefore people are still carrying forward the certain balance in their EC and SSGC. So one needs to take a call. Strictly speaking, as per government's FAQ also, which is as a disclaimer they have given, it is not a law. So as per government FAQ, the credit of KKC, EC and HSGC cannot be carried forward. But KKC, if you are a service provider, it was an eligible CENVAT credit, you should carry forward. For EC and HSGC, depending upon the quantum and depending upon the government's intention, one needs to take a call, and accordingly it can be taken. Or if you are going to, if one needs to go through a very non-litigative view, then the credit should not be carried forward here. One more important thing which has recently come up in a notification which has come out on 15th of this month, there is one section called 140 subsection 9 under the CGST Act, which relates to taking the credit of service tax for non-payment to the vendor under erstwhile Rule 647 of the CENVAT credit rules. So as per the latest notification on 15th of September, the department has told that such credits which was reversed or not available to the SSE because of non-payment to the vendor within 90 days of the date of invoice, and if the payment is made within the month of July, then this credit can be taken under 140 subsection 9, and the disclosure of such credit has to be done in column 5A. Now column 5A would be this column, wherein you have to write CENVAT credit admissible as ITC. The issue which is coming up when the same is being done, suppose your balance of service tax return is rupees 100 and your admissible credit is also rupees 100, but you have certain credit of 140 subsection 9 as per 47 of the CCR due to non-payment to the vendor within 90 days. So when you want to take the same credit, so suppose that credit is rupees 10. So if you write in your balance of CENVAT credit as per the last return 100 and you try to carry forward 110, the system will show an error stating that the carry forward credit cannot be higher than the credit in the return. So though the government has brought a rule under, has notified 140 subsection 9 to be for carry forward under column 5A, but still the infrastructure mechanism has not yet been developed by the GST and still now, and therefore this error is coming. So if one needs to take the credit, what one needs to do, one needs to increase the same amount in the carry forward as per return also, and accordingly to show the same as transitional provision. Whenever the transition checking is done by the department end, you have to show the circular notification copy and you have to take a screenshot of that error copy when you are showing the return balance as less and the admissible balance as more. So if you have these documents with you, I think it will not create a problem and you would be allowed to carry forward the credit without any litigation in near future. Next is column 5B. So 5B speaks about details of statutory form received for which credit is being carried forward. So if you are carrying forward any VAT credit under the GST regime, if you are carrying forward any VAT credit under the GST regime as per the respective state VAT Act, and you have any pending F form, C form and H form or I form pending, then details of such pending forms has to be given. But here in the column 5B, they are only asking for details of statutory form received for which credit is being carried forward. So suppose you have received the F form, C form and that credit is still you are carrying forward under the GST regime, then you have to give this detail. Otherwise, this detail is not required if you are not carrying forward any VAT or VAT credit under the GST regime. Next is 5C. The 5C speaks about amount of tax carried forward to credit ledger as state tax. So if you are carrying forward VAT credit, then you have to fill in 5C. Like 5A was for excise and service tax, 5B was for C form, H form, F form and I form for which credit is still being carried forward, and 5C is the amount of VAT credit which you are carrying forward. Now, and what are the details? They are asking for your existing existing PIN number under VAT, the balance as per the last return, the turnover for which the forms are pending, and the differential tax payable. So suppose your turnover for C form is pending, C form is 200 rupees or 1000 rupees. So the differential tax payable would be, suppose your goods was taxable at 14.5 and you had paid CST at 2%. So differential tax payable would be 1000 into 12.5%, which amounts to 1200 and 125 rupees. Similarly, this is for F form, this is for I form, and ITC reversible related to F and I form. So as soon as you fill in these details, the transition ITC balance would be adjusted. So suppose you are carrying forward the ITC as per VAT return of 1000 rupees and there is a turnover of C form which is pending and F form which is pending. So the differential tax liability would be adjusted and the net transition ITC would be only carried forward. But mind it, this is not what the law speaks. The law tells us that okay, if you are carrying forward VAT credit and you have C forms pending, you have to bring that C forms within 30th September, and after the 30th September, if the same is not brought, recovery mechanism can be taken. But it is important to note here that all this recovery mechanism has to be done when the assessment under the respective state statute takes place for the period 15, 16, 16, 17 and 17, 18 first quarter. GST department somehow would not be able to suo motu add the differential tax payable in this form. So there is some loopholes there. So again, if you are carrying forward the VAT credit and there is C form F form pending, mind it, your transition ITC may be negative also, because if your C form and F forms are pending in huge numbers, the turnover is huge, but the closing credit carry forward is less then the differential tax payable, then your ITC may be negative, and which may be given as a negative effect in your electronic credit ledger also. So please be very sure before taking this credit, because this credit is something not very easily available. You can take it, but it would be subject to 100% verification as per latest CVC internal report circular, which has come in public domain also. Next, we come to part 6 of the form, which is details of capital goods for which the balance credit needs to be taken under the GST regime. So here this particular section is 140 subsection 2. 140 section is subsection 2, as we have already discussed, deals with about if you have an excise SSC, you had purchased certain capital good maybe in the financial year 16-17 and you have not availed the 50% balance capital good credit in the quarter 1st April to 30th June, then you may avail this credit here. Also, if you have purchased certain capital good during the first quarter of 17-18, the balance 50% of the same can be easily availed here. Nothing much to describe on this slide. Similarly, the provision is for state tax, but state tax generally there is no such law for reversal for carry forward of the tax credit, less tax credit under the state laws. Some states may have the same, so they have given the same for state tax also. Next, we come to serial number 7. This particular scheme is in respect to serial number 7 of the TRAN 1 form. So TRAN 1 serial number 7 basically deals with 140 subsection 3. As per section 140 subsection 3, what we have already discussed in our earlier sessions, it is a section wherein if your product was exempted under the old law and under the GST, the same has become taxable. So whatever is your closing quantum of raw material, FG or finished good or your WIP or your inputs held in stock, from which you would be making taxable supplies under dutiable supplies under GST regime, and you can substantiate that you have an invoice, excise invoice or a VAT invoice or a tax invoice for the same, then the government tells you to the extent of your closing stock of finished good or WIP or input will allow you the transition credit. So 140 subsection 3, the detail they are asking for is HSN as applicable at 6-digit level for excise, unit of measurement, quantity is the amount, is a quantum of the goods, the value of the goods, the eligible duty is paid on such input. So eligible duty here would include excise duty, CVD, SAD, whatever was eligible. As per 140 subsection 3, eligible duty definition also includes CVD and SAD. So whatever is the eligible duty, you have the document that will come here. Whether the duty paid invoices are available or not. If you select yes, then no issue. You have to give the details. Nothing has to be mentioned here. If duty documents payable are not available, then the same would be allowed to be taken as credit only after you file TRAN 2 on 60/40 basis, which is also only available for a trader and not for a manufacturer. Type of goods, you have to select input, semi-finished good or finished goods. See, when you have selecting no, when the duty pay, where the duty paying invoices are available or not, if you select no, then the eligible duty on paid input becomes 0. Automatically it is freezed, because in this case you will be getting the credit on notional basis after you make a supply of the particular of your output, or on 40 or 60% basis as the case may be. So this is therefore the eligible duty, automatically the system freezes it to 0, and when you select it as no. So next, coming to 140, this would be serial number 8. This would not be serial number 8. This would be serial number. Okay, this was actually inserted after the by an amendment in this rule. So this would be a continuation of the same serial number, but it relates to section 140 subsection 5, wherein wherein the duties wherein there, well, as I told you earlier, you have certain invoices which for excise or VAT or service tax, which you have received in the month of July. So you have already submitted your service tax and VAT and excise return. You are not able to take the credit of these invoices which you have received later. So the under 140 subsection 5, the law allows you to take the credit of the same provided the same is accounted for in your books of account within 31st of July. So what are the details they are asking for here? They are asking the registration number of the supplier or the ISD, the invoice number, the invoice date, description of the goods, the quantity of the goods, the unique quantity, maybe numbers or kilograms or such other measurement quantity, the value, the eligible duties of VAT as well as excise, central tax, and the date on which the recipient enters in the books of account. So the books of account, it has to be before 31st July. This period has to be between 1st of July to 31st of July. If you enter this period after July or prior to July, the system will not accept the same. It has to be between 1st of July to 31st of July. This is again 140 subsection 3, which was there for excise, the same is for VAT. Nothing new provision here. This comes for centralized registration SSE. Again, there is a section 140 subsection 8, wherein the law tells us if you are a centralized registered SSE under the service tax regime and you have certain credits to be carried forward under these, if you are a service tax SSE having centralized registration under the service tax regime, so you have filed your service tax return from the premise from where you have taken centralized registration. Now, under the GST regime, there is no concept of centralized registration. So, what is happening? Suppose you have a closing CENVAT credit of 1 lakh rupees in the location of West Bengal. But now there is a GST liability for the month of July and August, which is coming up at all the locations. So, as per this section, this form, this particular page, the government tells you, okay, we will allow you to transfer this credit to the respective other locations, and in such case the respective other locations will get the amount of credit which you want to transfer. There is no restriction that you have to transfer or you have to transfer based on certain turnover, nothing. If you have a liability in a particular unit and you have CENVAT credit at your centralized registration, you may very well transfer 100% of the credit also. So they want the registration number under existing law, the service tax centralized registration number, last return date, the balance carry forward, the GSTN of the receiver. This is important. So now, suppose from West Bengal you need to transfer, you want to pass on the certain credit to your unit under GST in Gujarat. So you have to mention here the Gujarat GST unit and the amount of ITC which you want to transfer of central tax. An invoice number you have to give because this has to be documented. So you have to issue a tax transfer document which should be an invoice number. That number has to be given and the invoice date on which you have to transfer. So suppose if you want to take the benefit in the month of August, so this invoice date should be in the month of August. It should not be after the month of August, otherwise this credit may not be allowed. It may not be linked with the payment of GST. Next, there is a certain details which is required at the end of the principal and job worker under section 141. So whenever, as per this law, if the principal has sent certain goods to the job worker and it is still at the end of the job worker, as on the cutoff date on the appointed day, this particular 9A table has to be filled in. So the details of the challan through which the principal has sent those goods, the excise challan number, if the job worker is registered, the job worker number, the details of goods with the job worker, what is the HSA and what type, what is the description of the goods, how much quantity and what is the value of the goods, those detail has to be given because as per the 141, if the job worker returns his goods within 6 months of the appointed day, then he will not charge any GST and you can take the credit. But if the job worker does not send it after the 6 months of the appointed day, within the 6 months of the appointed day, then if the job worker is unregistered, you have to reverse your ITC, and whenever you sell the same, then only you can take the ITC, otherwise not. So to comply with this provision, table 9A is there. This is particularly for the job worker, again similar form, wherein what goods the job worker has to file a declaration that these goods are with me. So when the principal files, the same has to also be accepted and filed by the job worker. If the same both does not match, then there would be issues in filing of the same. Means the total quantum of the amount should be, the quantity and the description of should match if the job worker is registered. Similarly, when the goods are sold through agent, those details are required. If the agent is registered, then the description and the GST number of the principal, all those details should be required under to be filled in column 10A and 10B in case of details of goods held by agent. 142.11 subsection 142 subsection 11 subsection C. This is a provision wherein under the transition provision the system was developed wherein it was stated that if you have paid VAT and service tax both on a single transaction, then under the GST regime the credit of the same may be availed when you are billing. Under the GST regime you have billing under GST, but same amount has already suffered VAT and service tax. Then they say, okay, we'll give you the credit of VAT and service tax. So to that extent, to avail that credit, 142 subsection 11 subsection C is there. Table 11 requires you to give the registration number of VAT, service tax, the document, the invoice number, the invoice date, what amount of tax you had paid, the amount that you want to avail as VAT credit and what you avail as service tax credit. Then is the goods sent on approval, 142 subsection 12, table 12. Basically, in case of jewelry industry, you see people sending goods on approval. In white good consumer industry also, people are sending goods on approval. The details of such goods which have been sent on approval and it is not in stock with the person has to be filled in here. The document number, the date through which it was sent, the name of the recipient, the address, and what are the HSN and what is the value of the goods, because if the same does not come back within 6 months of the appointed day, then the person sending the same will have to charge GST on the same. So as regards transition form, there is one more important thing. This was more about disclosure of the form, but there are 2-3 important things which we can discuss here is regarding the time period of filing of this transition form. Regarding the time period of transition form, as per the GST Council meeting on 9th of September, it was stated in the press release that the Council has decided to increase the time period of filing this form by 1 month to 30th October. To that extent, there was amendment in the rule. Rule 120A was inserted under the CGST rule, wherein it was provided that those assessees, if I can read out that particular rule, because there is a lot of confusion going on between various places. Wise notification 34 by 2017, central tax dated 15 September. Rule 120 sub capital A was introduced, which stated every registered person who has submitted a declaration electronically in TRAN 1 within the time specified in Rule 117, 118, Rule 119 and 120 may revise such declaration once and submit the revised declaration in Form TRAN 1 electronically on the common portal within the time period specified in the rules, or such period as may be extended by the Commissioner, or such further period as may be extended by the Commissioner in this behalf. Now, in line with this 120 subsection 120 capital A, Order 2 of CGST was passed, wherein the Commissioner under powers of 120A and other powers has issued an order in which it has been stated that the due date as mentioned under 120A is extended by 1 month to 31st October. So on a harmonious reading of that order read with 120 subsection A, 120 capital A section, it is seen that only those assessees who have filed their TRAN 1 up to 30th September or 28th September as the case may be, would be given this benefit of filing a revised TRAN 1 up to 30th of October. On a harmonious reading of Rule 120A read with the Order 2 of the CGST by the Commissioner Upendra Gupta, it is seen that only those SSEs who had filed TRAN 1 within this period of the original period of 28th of September would be allowed to revise the same up to 30th October. So there is a confusion going on whether the due date of GST TRAN 1 has been extended to 31st October, because if you read the press release of the GST Council after the 9th September GST Council meeting, it was seen in the press release it is stated that the GST Council has approved for an extension of 1 month. Revision was separate and extension of 1 month. So this extension of 1 month is either linked with revision, or this extension of 1 month is only for those who are filing the time within time, is again a question mark. Uh, suitable clarification is expected from CBC on this account, because until the clarifications comes up, it becomes difficult for us to know whether that much time is actually available or not to file the TRAN 1 or not, because there are huge credits which people are carrying forward to avail in the TRAN 1. Another 2-3 important issues under TRAN 1 which I need to discuss is, suppose you were an SSE who had migrated from excise regime to service to the GST regime, and under your migration form, while filling up the details of existing registration, somehow inadvertently you have not filled up your excise registration number. So in that case, if you are trying to carry forward your CENVAT credit of excise duty into the GST regime, the system will not allow you to do so, because the system will show an error stating this excise number is invalid. The reason of it being invalid is you have not filled the same excise number during the time of migration, so the system cannot know whether this is your GST number, your excise number or not. So please, whoever wants to take the transition credit, please make sure your migration form, now the non-core amendment field is also optional or is also ready, has also started. Please make sure you all amend your forms. Whatever was your existing excise, service tax or the VAT or TIN number, please ensure everything is mentioned correctly, and you file the non-core amendment particularly as soon as possible. If it is not there, and then only the balance of credit would be allowed to be carried forward, otherwise not. Other issues would be as regards computation. So majorly the computation issue would come under 140 subsection 3 as to how to avail the credit, proportionate credit, my exempted goods if I was dealing in exempted and taxable goods both. How do I take the credit? What are the mechanism? So those I believe is as per the law. People who are there by this time have a fair knowledge of how to compute the eligible credits under GST regime transition. Now I'll just have a brief discussion about the e-way bills. So this e-way bill has been a talk of the town recently, but again with all this GST returns and everything coming into picture, the e-way bill has been, provision has come up, but people are still under the first they want to file all their TRAN 1 and all these forms, and then only they think we should be able to move into and understand what actually would the e-way bill be. So under this situation, government has come up with e-way bill rules. Actually, it is not e-way bill rules. It should be CGST rule 138, which was not notified under when the CGST rules actually came up from 1st July. So now they came up with this notification of 30th August, wherein they amended the CGST rules and inserted the rule 130. They substituted the rule 138 to bring in the mechanism for this, for notifying the e-way bill provisions. So what are the basic e-way bill provision? If we can just have a quick glance through it. Basically, e-way bill, the government intends it to be a document which should be required in case wherever there is a movement of the goods. Now, the movement of the goods can be between registered persons, can be between registered to unregistered persons, and can be fully between unregistered persons under the GST regime. If my threshold limit is below 20 lakh, I am a trader, I am sending some goods from a particular place to another place within West Bengal, within the same state, and up to a notified 10-kilometer distance or above that 10-kilometer distance, but I and my recipient both are unregistered. How to generate that e-way bill and things like that would be an issue. So coming to the provisions, e-way bill is basically an electronic way bill that allows movement of the goods. Whenever the e-way bill will be generated, a unique e-way bill number EBN, e-way bill number would be generated and communicated to all the parties. So in a transaction per e-way bill, there may be maximum 3 parties: the transporter, the recipient, and the seller. So when the e-way bill number is generated, it is made available to all the 3 persons. Date of implementation of e-way bill not yet notified. It is, I still doubt it coming in October, because government as of now it is not ready with the TRAN 1 with the correct GSTR 1, 2, 3. So e-way bill coming into picture, maybe it may take some time, but yes, the provisions are there so that people may be aware. So what is the time and scope of e-way bill? The law says every registered person who causes movement of the goods, every registered person who causes movement of the goods in relation to supply or for reasons other than supply, means under delivery challan you are giving, for sales return, for sale or approval basis, any other reasons, or due to an inward supply from an unregistered person, or due to an inward supply from an unregistered person, then e-way bill would be required to be generated. There is a threshold limit of consignment value of 50,000 rupees. So if your consignment value is up to rupees 50,000, then e-way bill is not required. Also, e-way bill is not required for a distance of less than 10 km within the state. E-way bill is not required. So you have to see, e-way bill is required to be filed before the commencement of the such movement, where the consignment is value of more than 50,000. Now this 50,000, whether it is inclusive of tax or exclusive of tax, is not yet clear. Generally, it should not include the tax component. It should include only the value of the goods for the purpose of transporting. So suppose A and B are two registered persons, and A is sending goods to B. Then e-way bill is required to be generated by A before commencement of the movement. However, B may generate the same where he causes the movement of the goods. In what case the B may generate? Suppose ex factory movement, ex factory sale. Suppose I am taking certain goods from you and I am sending my truck. You are loading the goods there, so it becomes an ex factory sale. In that case, the goods are being transported, are being moved at my instance. So in that case, I may give a e-way bill. In such case, I have to give a e-way bill. Suppose A is registered but B is unregistered, and A is sending the goods to B. So e-way bill is to be generated by A before the commencement of movement. What happens if both A and B are unregistered? So in case both A and B are unregistered, the e-way bill has to be generated by the transporter or at the option of A and B. But how law tells, law does not give you any mechanism for unregistered person to generate e-way bill. I think suitable amendment in that regard would be required. Clarification would be required that it is compulsory wherein the consignor or consignee are unregistered but the value of goods are more than 50,000, whether e-way bill is required or not. That clarification would be still required from the government side. So e-way bill is applicable to movement caused by registered person of consignment value exceeding 50,000 through motorized conveyance. What is non-motorized conveyance? rickshaws, carts, maybe two-wheeler, but two-wheeler I think would be included if somebody is transporting goods to two-wheeler, that may be a part of the motorized conveyance also. So if you are transporting goods through motorized conveyance, then only this e-way bill procedure would be coming up. If it is to non-motorized conveyance, then not required. Where the consignment value is less than 50,000, it is not required. Where the goods are for goods used for personal use, it is not required. Where the household effects are being transported, it is not required. Currency is not required. Plus, there is a schedule which has been given, annexure A to Rule 138, sub rule 14. They have given an annexure where they have given a list of goods for which the e-way bill would not be required. So, in such situations, if you transfer goods also, transfer those particular goods, e-way bill would not be required to be filed. E-way bill would not going to be generated. But again, it is optional. If you still want to generate the same for your convenience of movement of the goods, you may generate the same. So who can generate? Every registered person under GST when before movement of the goods. What they have to do? They have to fill in Part A. The Part A, nothing much is there in Part A. Part A only discusses about what are the details required. So very brief details of Part A would be the GSTN of the recipient, the place of delivery, invoice or challan number, the invoice or the challan date, the value of the goods, HSM, reason for transportation, and the transportation document number. So GST of the recipient, value of the goods, HSN of the goods, invoice number, invoice date, place of supply, and the transport document number. So these information is also already there, would already there in your invoice. So only punching of information to be done at the time of dispatch to generate the e-way bill. It is not a very big document that you have to punch in many details. Maybe coming time the software may be accustomed. The ERPs would be developed wherein through ERP directly all these information would come up and you can directly generate the e-way bill through your respective softwares after logging into the GST, of course. Registered person is a consignor or consignee or is a recipient of goods. One has to fill Part B. Now this Part B is a very funny thing. It only contains vehicle number. So Part B, suppose you have handed over the goods to the transporter. You have generated Part A. You have filled in Part A. So in that case, when the goods are handed over to the transporter and you have only filled in Part A, Part B would be filled by the transporter because vehicle number would be inserted by the transporter. So here comes the importance of the transporter under the GST regime. The whole logistics sector depends upon the transporter, the transporters and the goods transport agencies. Today, goods transport agencies are not registering, saying my 100% reverse charge liability is there on the recipient, so there is no need of registration. Agreed to that. But again, when you need to come into a GST regime, when you have to be a part of this GST law, when you have to generate this e-way bill Part B, or maybe in situations where you have to generate both, if you are transporting for unregistered persons, when you have to generate e-way bill. So therefore, you have to register yourself with GST or you have to enroll yourself in the GSTN by filling ENR 01. So that form is also there, which has not been, it is there in the rules, but the online this form is yet to be come up. So all transporters who are not yet registered somehow will be under the GST net by furnishing ENR 01 form. What is the validity of the e-way bill? Details of e-way bill generated shall be made available to the recipient if registered on the common portal, who shall communicate his acceptance within 72 hours. If he does not accept, it will be deemed to be accepted. So validity is up to 100 kilometer 1 day, and for every 100 kilometer an extra 1 day. So it is not linked to first 50 kilometers or first 100 or up to a maximum days. It is for total distance to be traveled. 1 day per 100 kilometers is the validity of the e-way bill. In case of transit sale, wherein I have transported through a transporter who again after traveling some distance through in another state transport is to another transporter, then in that case the vehicle number needs to be updated by the transporter under e-way 0 in e-way 2 and then he can transport the goods further from there. So what document needs to be carried by a transporter? The invoice or the bill of supply or the delivery challan, the copy of the e-way bill either physically or mapped to RFID technology, and certain category of transfer will be notified to obtain a unique RFID and get the said device embedded on the conveyance and map the e-way bill to the RFID prior to the movement. Such transporters, I believe, may be those transporters who are not registered under GST and who are already enrolled, only have filled the enrollment form. So the department may make a compulsion on those transporters to bring this RFID technology so that scanning of the truck, scanning of the e-way bill can be done easily through a distant location also. So basically, e-way bill for physical movement of the goods exempted up to 10 km and 50,000 rupees value. It is not required of the consignment. In case of multiple consignment, the law has a provision the transporters can generate a single e-way bill. After generating the total e-way bill, they can have a consolidated e-way bill in GST EWB2 and insert the key number, serial numbers of individual e-way bills, because it always a transporter may carry in one conveyance goods for more than one clients, customers of the transporter. So there is an option of consolidated e-way bill also. But yes, this e-way bill is a historic step towards improving the logistic structure in India. As of today, every state government has operated the transition e-way bill structure, wherein some states are notified for inward, for outward, for local movement also. With this centralized e-way bill coming into picture sometime maybe in October or November, the whole concept of movement of the goods, the whole litigation wherein the department says that this invoice, there is no movement of the goods, it is only an invoice on which credit has been taken. All those things can be covered up, because to move the goods from one place to another, you have to generate this e-way bill. And if you have generated e-way bill, you have not moved the goods, then you have to cancel the e-way bill. And there will be all information available with the department as soon as you insert the e-way bill. Because you are giving the taxable value, the HSN, the rate, the value of the goods. So there cannot be any situation of amendment in the invoice. Any amendment which has to be done to a debit or credit note. Today people have a habit to change the invoice directly. But now when this e-way bill will come into picture, everything would be consolidated and department will have a ready information of all the things together. So it would be difficult to change any information which you have already portrayed to the government. We have one question from Mr. Raja. What is the process if job worker is unregistered? Sir, if the job worker is unregistered, the job worker will send the goods to a delivery challan. Within 6 months it comes, nothing to be done by the registered SSC. If it comes from a job worker after the 6 months of period, then the registered SSC has to reverse the ITC which it has availed of excise component under this excise regime while sending the goods to the job worker. If you see the provisions of job work of excise rule under rule 45A of the CENVAT credit rules, it stated you can send the goods to the job worker provided the same is coming back within 180 days, and for capital good it was 3 years. Same provisions are there under the GST regime, but for transition stock it is not so. For transition stock, they have told it you have to bring back within 6 months. So to that extent, if I can go through 141, where any inputs received at a place of business have been removed as such to a job worker for further processing before prior to the appointed day, and such inputs are returned to the said place after the appointed day, no tax shall be payable if the such inputs after completion are returned to the place within 6 months from the appointed day. 6 months may be extended for a further period of 2 months. Provided if such inputs are not within the period specified in this section, input tax credit shall be liable to be recovered in accordance with 142(8)(a). So if you go to 142(8)(a), what does it say? 142(8)(a), where in pursuance of an assessment or adjudication proceeding instituted before or after the appointed day under the existing law, any amount of tax becomes recoverable from the person, the same shall be recovered. The same shall, unless recovered under the existing law, be recovered as an area of tax under this act, and the amount so recovered shall not be admissible as input tax credit. So it is very clear. If it does not come under within 6 months, the ITC which you had received, the ITC which was there, you have to reverse the same. It would be recovered from the government. So this was all from my side. Thank you very much for a patient hearing. Thank you.